We are examining the grace period provision for the national portion of the life insurance exam, which serves as a vital safeguard for policy owners and is a topic you are guaranteed to see in some form. This provision is essentially a safety net designed to protect individuals from losing their coverage due to a brief delay in premium payment. On your exam, you will need to recognize that the grace period is a mandatory provision required by law, and it typically lasts for 31 days following the premium due date. During this specific window, the policy remains in full force even though the premium has not been paid. This is a major point of emphasis for test writers who want to see if you understand that the insurance company cannot deny a claim just because the check is a few days late. Imagine a scenario where a policy owner has a premium due on October 1st, but they completely forget to mail the payment or their bank account has insufficient funds. If that individual passes away on October 20th, the policy is still technically active because it is within the 31-day grace period. However, the exam will ask you exactly how much the beneficiary receives in this situation. This is where many students trip up. The insurer will pay the death benefit, but they are legally allowed to deduct the overdue premium from the total payout. If the policy was for $100,000 and the monthly premium was $200, the beneficiary would receive $99,800. You must remember that the coverage does not simply vanish the moment a deadline is missed, but the insurer is entitled to the money they were owed for that period of protection. One of the most common traps you will encounter involves the specific length of the grace period. While some policies or state-specific rules might vary, the national standard discussed on the exam is 31 days. Be careful with trick questions that suggest the grace period is only 10 or 15 days, or questions that imply the policy lapses immediately at midnight on the due date. Another confusion point is the difference between the grace period and the reinstatement provision. The grace period happens before the policy lapses, while reinstatement is the process of putting a policy back into effect after it has already lapsed. If you see a question about a policy that has already terminated, you are looking for reinstatement rules, not grace period rules. When you are looking at the answer choices, pay close attention to the wording regarding the status of the policy. The examiners will often use terms like in force or active to describe the policy during the grace period. If an answer choice suggests that the policy is suspended or that the company has no obligation to pay a claim during these 31 days, you can immediately rule it out as incorrect. The primary intent of this provision is to prevent unintentional lapse, and it acts as a consumer protection mechanism. To help you remember this concept during the high-pressure environment of the exam, you can use the mental shortcut that 31 days of grace keeps the policy in the race. This reminds you of the specific time frame and the fact that the policy is still running and valid. You should also keep in mind that the grace period applies to all types of life insurance, including whole life and term life. If the exam presents a scenario involving a specific policy type, do not let that distract you from the universal rule that the grace period must be honored. By focusing on the fact that coverage remains active and that the premium is simply deducted from the death benefit, you will be able to navigate even the most complex situational questions regarding policy lapses.